Today, we're diving deep into Bitcoin's price action with a massive technical breakdown, and we'll be unpacking 12 of my go-to charts. With Bitcoin teasing all-time highs but struggling to break through a stubborn resistance level, the market's giving us plenty to dissect. So let's dive in. Bitcoin is really struggling to break through its all-time high with any serious conviction. We're seeing wicks get sold off quickly, keeping price action firmly below a key resistance level at $110,000. That said, chopping around this level is completely healthy, especially when you consider the strong run-up we've had from the deep value zone around $75,000. It's been a solid move higher, and now the key level of support I'm watching is $103,000, which has decent historical precedent. I'm more than happy to see consolidation around this area before any potential push higher. So, are we still in a bull market? Well, one of my favorite ways to gauge market strength is by looking at the 30-day and 365-day moving average cloud. It offers a clean visual read on whether the trend remains intact, and it filters out a lot of the noise you'll see online. As long as the monthly moving average stays above the yearly, I consider the bull trend intact, and I'll maintain that stance until the trend is clearly broken. Another powerful tool for gauging market structure is the 200-day moving average, easily one of the most widely followed indicators in both crypto and traditional finance. In every past bull market, this line has acted as a critical divide between trend continuation and breakdown. So far this cycle, every approach to or dip just below the 200-day moving average has been a fantastic buy the dip opportunity ahead of the next leg higher. We've seen a few orange dots along the way as the price rallied, but no prolonged bursts or red dots, which have historically signaled local or even cycle tops. Right now, the 200-day sits at $95,000, so any pullback to that level should be considered an excellent buying opportunity, assuming you still believe the bull run has room to run. Shifting focus to technical pricing levels, the 111-day moving average also deserves attention, especially when it converges with the 200-day average. Every time that's happened during this cycle, it's been followed by an explosive move higher. These moments, when the two moving averages draw close, often correspond with periods of consolidation or broader market pessimism, conditions that tend to shake out weaker hands before a powerful upward move. Even though we're hovering near all-time highs, this still looks like a consolidation phase. And that's not a bad thing. It's actually what you want to see. A market becoming comfortable at these levels. Zooming in on the 111-day average, while we've seen some solid rallies, we've yet to witness the kind of vertical, explosive action that marked the tops of the previous two bull cycles. We're not seeing dark red indicators, just some mild yellow zones, which suggests this bull market is playing out in a more measured, step-laddered fashion, rather than the wild swings many have come to expect. To add more context, let's look at the volatility waves indicator. Since 2020, Bitcoin's overall volatility has been trending lower, and that's to be expected. As Bitcoin matures, with a higher market cap and broader investor participation, lower volatility is natural. Sure, we still get spikes, but this trend explains why we're not seeing the same face-melting moves from past cycles. But lower volatility isn't necessarily a bad thing either. In fact, it's one of the reasons institutional investors are becoming more comfortable allocating to Bitcoin. Even with diminished volatility, Bitcoin continues to outperform traditional asset classes on a risk-adjusted basis and still holds the potential for life-changing returns. Now, looking through the lens of momentum, yes, we might still be in a bull market, but the big question is, how long can we stay here? That's where my bull momentum gauge comes in, which I covered in detail in a separate video. At the moment, it's right at break-even, perfectly aligning with the muted price action we're currently seeing. Even though we're sitting at all-time highs, it still feels like the market is searching for that next compelling narrative to push us higher. I'll be monitoring this closely. If it stays red for too long, that's when I might reconsider my broader thesis. But for now, the trend remains intact. Speaking of trends, one of my favorite tools for assessing market momentum is the trend vector. In short, it measures weekly directional movement, specifically the strength of upward price movement relative to its average. It effectively reveals how robust the current trend is. Interestingly, we hit a major bottom signal around $75,000. And since then, the trend vector has turned upward, which is encouraging. However, the one caveat here is the potential for lower highs forming in the trend vector. It's too early to call, but this could be an early signal that the strength of the current rally is beginning to fade. Only time will tell. Now, rather than focusing solely on what the market's doing now, let's consider where it might be heading. One of the most popular and respected valuation tools is the Mayer multiple. It's historically done a great job identifying key inflection points in both bull and bear markets. Right now, the Mayer multiple is sitting around $95,000, which keeps coming up as a key level. From a technical standpoint, this appears to be a fair value zone. And interestingly enough, that number is also very close to the short-term holder cost basis. So, if Bitcoin were to drop to $95,000, I wouldn't view that as a failure of the bull trend. In fact, I would argue we'd still be well within the bounds of a healthy cycle, and there would be no reason to panic. If the bull strength continues, a logical next target would be the 1.6 Mayer multiple extension line, which currently sits around $152,000. We've touched or exceeded this level on the way up before, and it's by no means out of reach in the near to mid-term future. The next level above that, the 2.4x extension, marked in red, represents what I'd call the over-exuberant phase. This is where markets often detach from fundamentals, driven instead by speculative mania and parabolic price action. Historically, when Bitcoin has reached the 2.4x extension, we've seen either the blow-off top of the cycle or a major local top forming not long afterward. These moments tend to coincide with maximum hype, peak greed, and retail participation entering in full force. That's not inherently bad. It's just part of how market cycles tend to work. But if we get anywhere near that level again, it's where I personally start thinking about de-risking or taking some profits, depending on what the broader mix of on-chain indicators are showing at the time. Right now, we're nowhere near there yet. We're closer to fair value than mania. And while that might feel frustrating for those hoping for quick fireworks, it's actually a good thing. It means there could still be meaningful upside ahead, especially if we continue consolidating in a healthy way and resetting momentum indicators without triggering any of the classic top signals. Finally, let's touch on another fan favorite, the Pi Cycle Top Indicator. This tool has earned its popularity, especially among retail investors, thanks to its remarkable historical accuracy in identifying Bitcoin cycle tops, often within a matter of days. But while its track record is impressive, it's important to note a subtle yet critical evolution. The strength of the actual moving average crosses has been diminishing with each successive cycle. Earlier in Bitcoin's history, these crosses were sharp, pronounced, and often marked major peaks. But by 2021, the most recent cross barely cleared the threshold. It was more of a technical flicker than a definitive top signal. That weakening impact is important because relying solely on the classic Pi cycle cross might no longer cut it in a maturing market. To account for this, I now lean more heavily on the Pi cycle oscillator indicator, my custom adaptation of the original model. It recalibrates the signal by taking into account the reduced potency of each new cycle's crossover, rather than waiting for a full, clean cross to occur. The key focus is now whether the oscillator breaks above the upper white trend line. That breach has proven to be a far more timely and actionable signal in the current market climate. In fact, it's entirely possible that this oscillator could peak, or nearly peak, without a full cross ever happening. And if you're sitting around waiting for that perfect textbook signal, there's a real risk you'll miss the top altogether and be left holding the bag while the market turns. So, to wrap things up, the overall picture is that Bitcoin's bull trend is still very much alive. Multiple indicators back this up, showing the trend remains intact. However, momentum is definitely showing some signs of fading, which means we need to be cautious and watch how this develops in the coming weeks. It's not unusual for a mature bull market to lose a bit of steam after a strong run, so patience is key here. Another important takeaway is the significance of the $95,000 level. This price point keeps popping up across various metrics, from both technical and on chain models, and it looks like a solid fair value zone. If Bitcoin dips back to this level, it shouldn't trigger panic, but rather be seen as a healthy part of the cycle and potentially a strong buying opportunity for those who believe in the longer term bull case. Finally, what's clear from the data is that Bitcoin is behaving more like a mature asset than the wild, volatile beast we saw in previous cycles. Volatility is trending lower, and price moves are more measured and step-laddered instead of explosive spikes. This evolution makes Bitcoin more appealing to a broader range of investors who are looking for strong returns without the extreme swings we've come to expect. So, while the path forward may not be as dramatic as past cycles, it's a sign that Bitcoin is growing up, and that could bode well for sustainable growth over the long term. If you're serious about Bitcoin analysis, my full custom indicator suite is now live, built for investors looking to gain an edge through deep cycle signals and advanced on-chain insights. It's available now through the link in the description, where you'll also find my free newsletter. And if you found this valuable, hit the like button, subscribe to the channel, and turn on notifications so you never miss an update. And I'll see you all in the next one.